Finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Good morning. This is Adam Butler, representing the CFA Society Cayman Islands. As my guest today, I have my partner and also president of Resolve Asset Management here in Cayman. And we thought we'd kick off today with a discussion about what's happening in markets, specifically the strange experience that many investors have had watching the stocks and bonds in their portfolio over the last year, which I think has been really unfamiliar. I think we are used to having, observing the stocks and the bonds in the portfolio, noting that typically on any given day, week, or month, stocks might be up a bit, bonds might be down a bit, or vice versa. Stocks are zigging while bonds are zagging, but they typically go up over time. Both of them go up over time. This year we've had a very different experience. Not only did we go through quite a sustained period where stocks and bonds were kind of moving together in the same direction at the same time, but both of them have been drifting down. And so I thought it would be useful to revisit this concept of correlation in the portfolio, because the correlation between two markets in your portfolio plays a large role in the amount of risk that you feel in the portfolio, the amount it gyrates up and down from day to day and week to week. And I've discovered that most people have a very loose understanding of what it means to be uncorrelated. And this year, obviously, has really put a spotlight on this idea of correlation. So I thought maybe we could start, Rodrigo, with a discussion of what it means for two markets or two things to be uncorrelated. And I know you've got a nice metaphor that may help connect the dots.
Yeah, well, I think the first issue is the visceral reaction one gets when trying to explain this simply, right? You have an asset that goes up, zigs when the other asset goes down, and the visceral reaction is, why would I want something that takes away from the return of that first asset? I'm going to get zero at the end of the day, right? This is understandable. Why? Can you hear me?
Yeah.
Okay. It's understandable why you get that, but the reality is that non-correlation in assets that drift positively upwards over time is what we're talking about, right? And a way to discuss this that I've found useful over years is the idea, we're from Canada originally, and I always tell people that in Canada there are no ski companies and there are no bike companies. There are only ski and bike companies. They do both. Right? Because you can imagine that if you just own a ski company, in fact, you are likely to make money at the end of the year just by owning that, right? It's not to say that you can't make money. What you can do is you make money over the winter by selling a lot of skis. Then you batten down the hatches. You have a slow bleed in your cash flow. So you're having a reduction in your standard of living, a reduction in your cash flow. Hopefully you made enough in the winter time to reach the next winter and make some more money again, right? That's a way of living your life. But how can we reduce that cash flow volatility? Well, maybe we start selling bikes in the summer. And there's an interesting effect there. Number one, you're going to have the ability to make positive cash flows in that summer period, right? But the other benefit of this is the reduction of overall cash flow volatility, and also an increase of likely cash flows over time, because all the money that you made from that ski season, you can reinvest into the summer season in a way that you just can't reinvest when you only have one asset, right? So in essence, you have two assets or two strategies or two companies that both make money independently, but when you put them together, you reduce your risk and you possibly make a better return over time with a rebalancing of those cash flows.
Yeah, that's a really good point about the opportunity for reinvestment, because by having greater certainty in the cash flows, right, from having two different business lines running in parallel but operating at different seasons, then you have greater confidence and greater certainty, and that enables you to reinvest in the business at a greater rate than you would otherwise, right? Where you've got less certainty. Maybe you don't get much snow the next season, and therefore you don't sell nearly as many skis, or maybe the next summer is cold and rainy, you don't sell as many bikes, right? So at least you've got this offset that allows you to reinvest. So let's bring it back, right? Because I think what many investors don't quite get is that you've got two markets that can both be drifting higher at the same time, but meanwhile, on any given day, week, or month, they are zigging and zagging at different times.
Yeah, let's say they both drift higher over time, but at any given time, they're lowly correlated to each other.
Yeah, right, exactly. So the effect that this has had on a typical portfolio of, say, 50-50 stock bonds, or maybe a more typical 60-40 stock bond portfolio, over the last 35 to 40 years has been that typically stocks and bonds have been uncorrelated, often been negatively correlated, even better. And this has really reduced the volatility that investors have experienced, the magnitude of gyrations in the portfolio. If stocks and bonds become positively correlated, like we've observed over the last year, and like we observed in other periods where inflation reared its ugly head, like in the 1970s, like late 1960s to very early 1980s, that coincides then with a period of higher volatility of traditional portfolios of stocks and bonds, right? So, for example, if you go from a slightly negative correlation of stocks and bonds to a slightly positive correlation of stocks and bonds, then the average gyration of your portfolio goes up by 25 to 30%, right? So what that means is if you want to maintain, if you were comfortable with a level of portfolio gyrations that we had experienced over the last 20, 30 years, you're now experiencing portfolio gyrations that are kind of 30% higher than you are comfortable with, right? And so one option of how to deal with that is maybe to reduce your exposure to stocks and bonds in favor of cash. And, as you know, cash has become a lot more attractive again after a period of being, effectively having zero attraction.
Yeah, I think we were talking a couple of years ago that cash is trash, right? And that has changed very quickly. It gives us an opportunity to now add a third diversifier in that ski and bike example, right? Maybe you're, doing mountaineering in the fall season, but when rates were at zero, now we can bump that up depending on how you're getting access to it to 3, 4, maybe even 5% of a fixed rate in an environment where bonds and equities are continuing to try to tease out whether they're likely to be correlated with each other or likely to be going up in the next few years. So I think that the cash component is going to be a key element to reducing that gyration, reducing the maximum losses that one can experience. Because I think people were surprised by the fact that bonds and equities lost the same amount in the first half of last year.
Yeah, that was very unusual. We haven't seen a year like that since the late 1960s, the very early 1980s, and before that back in the early 1930s, yeah. Right? So it's certainly an experience that most investors aren't used to. Some people listening may be wondering, you talked about 4%, 5% on cash. I know that the banks are not currently providing that on bank deposits. So, where can investors go to get those kinds of rates?
Yeah, it really comes down to access to a good investment advisor, or if you're a self-directed person, you can open up accounts in independent broker dealers and like Interactive Brokers and whatnot, and identify high interest savings, money market funds, or even a laddered bond portfolio if you can buy it directly, because the bank's savings accounts are always going to be the lowest. They're always going to take a spread. Especially if you're not a Charter One bank in the United States, which is the place where you're getting the most money right now, and that safe assets that we care about, right?
Yeah, exactly. Yeah. So open an investment account, invest in. There are actually plenty of extremely low cost traded ETFs where the underlying holdings of that exchange traded fund are high grade short term corporate bonds, and the short term is key in this kind of environment because actually at the moment short-term bonds are yielding higher rates than long-term bonds, but also extremely short-term bonds are not vulnerable to further increases in interest rates. Typically you've got a bond out 5, 10, 20 years. When interest rates rise, the price of those bonds go down mechanically, and the magnitude of that relationship gets larger as you go further out in time. So if interest rates rise by 1%, then, a 1 or 3 month T-bill, the price of that won't fluctuate hardly at all. But a 20-year bond might drop by 10, 15%. So it's important during times like this when, A, you're getting paid more for holding shorter duration or holding, cash-like bonds than longer-term bonds, to focus in that area. And, it's unusual for short-term bonds to be yielding more than long-term bonds, but it's, let's take advantage of that opportunity.
That's right.
So I think it also is useful for us to talk about why stocks and bonds have been going down together, why they're currently positively correlated, and why we may expect them to go through an extended period of being positively correlated, and therefore investors who are continuing to hold the same portfolio should probably expect higher levels of average portfolio gyrations over time.
Yeah, so let's talk about the dynamics that affect asset prices, especially equities and bonds, right? I think, Adam, you've been on the radio, you've talked about this before, and we certainly have historically, but, you have a couple of dynamics that are important to understand. Are we in growth mode? Are we in a high growth of the economy or low growth, right? The second dynamic is going to be, are we in a high inflation environment or a disinflation environment or a deflation environment, right? So inflation and growth are important to understand, to know what the likely outcome of correlations between those two assets are going to be. And then the third dynamic is going to be how much liquidity there is in the system, right? Are we seeing a net influx of assets by money printing from the federal government, banks, and people, getting into the market? Or are we seeing a net outflow? And those three dynamics are really going to affect equity and bond correlation. And what have we seen for the last 40 years? From 1981, when Volcker broke the back of inflation. Largely, we've seen 4 decades where we were playing 2D chess, where that inflation dynamic, that high inflation, low inflation, was not an issue at all. And that's an easy thing for the Fed to deal with, right? When you're playing 2D, you just if you're in growth mode and the economy is on its own, you don't have to do anything. If all of a sudden there is a negative growth shock, then you have the ability as a Fed to print a lot of money until we get growth back up without any fear of inflation, right? And so it's been fairly easy to see. You've seen markets go down and then recover fairly quickly because we didn't have to think for a second about the impact of that liquidity into a system with regards to inflation. And as a Latin American, I can tell you, when you have that barrier, when you know that inflation affects the markets really quickly, now you get into 3D chess, right? And that becomes a really, really tough dynamic to deal with as a Fed, and everything becomes a bit more chaotic. So what happens when inflation rears its ugly head? Well, all of a sudden, you have to discount equities and bonds, whatever price they had. There's a discounting mechanism in finance that says if you can get more for cash today, every asset class needs to go down in value. And if rates are going up quickly, then you're going to see it much, much more acutely like we did this year. This is one of the highest and fastest rising rate environment we've seen in history. And what you saw is bonds and equities both lose to cash, right? They're both getting sold down at the same time because of this repricing of current cash flows. And so inflation led the Fed to increase rates. Now inflation is a problem we're going to have to wrangle.
Yeah, I think you hit on a really key point. At all times, risky assets like stocks and bonds are competing with cash for allocations. Like, if you're an investor, why would you take money out of safe deposits that don't fluctuate in price over time and that don't give you any stress about what their value is going to be, at least their nominal value, when you need it for consumption, to invest in risky assets that do fluctuate in value and do give you stress about, if you need to buy something, if you need to fund a university deposit or rents or buy a new car at some point in the near future, there's some ambiguity about what your stock portfolio and your bond portfolio is going to be worth, right? Whereas there's no stress about that in a cash account. So it requires your expectation of returns on stocks and or bonds to be higher than, and substantially higher than that of cash, to entice investors out of cash and into stocks and bonds. that dynamic operates the same way in reverse. So if all of a sudden cash was yielding nothing and had a zero return, now cash is promising a 4 to 5% return. Obviously, cash is a lot more competitive with those risky assets. If you can earn 4 or 5% with no risk, you've got to be looking at your stock and bond portfolio and the expectations for forward returns on those. And living in Cayman, a tax-neutral jurisdiction, you're not penalized in the same way as onshore investors for holding cash, right?
Yeah, for earning income, yeah.
Earning income, right? So there's definitely an even more interesting dynamic, competitive dynamic at play for people who are living offshore. So we'll talk a little bit about that three-dimensional chess problem when we come back after the break.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Can I send a request, please?
You don't really have to ask us. Just send a request.
This is a shout out to my ex.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
All right, we're back. This is Adam Butler. I'm hosting this on behalf of the CFA Society Cayman Islands today. And here with me, I have Rodrigo Gordillo, president of Resolve Asset Management, my business partner. And we've been talking about the different experience that investors have had over the last 12 months or so, where we went through 30 years of stocks and bonds kind of zigging and zagging at different times, but both drifting higher to a period like the last 12 months where stocks and bonds have been moving up and down largely together at the same time, and they've both been drifting lower. Obviously, a very unusual environment, and so we spent some time talking about how this change impacts investors' experience with their portfolio when stocks and bonds are now moving together as opposed to zigging and zagging at the same time. Then your experience of portfolio volatility is substantially different. You're experiencing a lot more higher magnitude gyrations in the value of your portfolio at the same time as your portfolio has been drifting lower, right? And so we talked about what correlation is, how important that is to the overall gyrations of your portfolio. And then we started talking about why we are experiencing this new environment of positive correlations between stocks and bonds. And we touched on the fact that the primary drivers of stock and bond returns are inflation. Is inflation higher or lower than expected? And growth. Is growth higher or lower than expected? And then we also talked about, or touched on at least, this liquidity axis as well, right? So we're going to talk about this, the fact that, we went through 30 years where investing was a relatively easy game because Volcker in 1981 gave the market confidence that central banks were going to do whatever it took to sustain a low level of inflation, to allow the market to have predictability in the prices that companies were going to pay for the things that they were investing in, the capital that they were replacing, and the prices that investors were going to pay at the grocery stores and at the pump, and in rents, et cetera, and buying the things that they need for their daily lives. So when we have this stable inflation environment, it's actually a much more simple game, because the only thing you're worried about is whether growth is going to come in higher or lower than expected. If you've got a decent estimate of where growth is going to be, then you can also do a decent job of estimating expected returns for stocks and bonds. Now we're in an environment where inflation has largely kind of gotten out of control in a way we haven't seen in 30, 40 years. That now means that instead of playing that two-dimensional chess game of stocks and bonds, we're now playing a much more complex game, right? I don't know if you've got any metaphors that might help to illustrate this idea of greater complexity.
Well, as you know, I like to exercise, and I'm an ex-surfer, and I think a good analogy is, you know, we've been trying to balance ourselves in a plank off of a cylinder, right? So you're either pressing forward or pressing backwards to find your balance. You said markets investing in the last 40 years have been relatively easy. It hasn't. You still have to balance,
sure,
right? But it is, you're either pushing forward or you're pushing backwards.
It's like a barrel roll.
That's right. That's right. And then all of a sudden inflation rears its ugly head, and we're no longer balancing in a forward-backward surface. We are on a ball. And when you're standing on a ball trying to balance, you know, there's going to be those that are good at it and professionals that know it and can balance well. But the vast majority of investors that have only played this two-dimensional balancing game all of a sudden have to learn how to stand up on that ball. And your gyrations get higher because there's many more dimensions that you're going to have to deal with, and there is nobody that can balance them perfectly. You're always going to, no matter how good you are at understanding the markets, you're always going to be over compensating one way or another, right? So in this environment, in this game where we're balancing ourselves on the top of a ball, we have to now learn and utilize the tools that'll help us minimize that gyrations in a more volatile environment.
Yeah.
Right. So we talked about cash, right? Cash has been good because you can get short-term cash as rates go up. But what are other tools that one might be able to use in order to minimize volatility in your portfolio? So what does go up when inflation goes up? That's the one part we're missing. We haven't even thought about this in 40 years because we didn't need to, right? So the asset that comes to mind would be commodities, right? Prices go up. A well-diversified basket of commodities is likely to go up in periods when there's inflation. Now, we've been talking about inflation in 2022, but the reality is that inflation started happening in 2020, 2021 in different areas of the commodity space. And so had you naturally had that tool at your disposal, you would have benefited tremendously. I mean, from 2020 to 2022 to the peak of that inflation burst, we saw a basket of commodities go up over 150% when your equities and your bonds were going down 20, 30%. Right? So this is now something that we need to perk up to and identify as a possible offset, a balancer, one might say, right?
Yeah.
Amongst other things.
Yeah, absolutely right. So one thing, certainly a first step, as you recognize that the environment's gotten more complex because we're now having to navigate along a whole new axis of inflation besides just growth, is that we need to rethink what diversity means and what diversification means, right? And commodities are a great way to hedge along that third axis. I think it may be illustrative for us to walk through a couple of scenarios to illustrate just how challenging this kind of environment is, right? So at the moment, the Fed has made it very clear that they are targeting a 2% inflation, right? At the moment, you've still got core inflation running well above 4% and headline inflation running well above 6%. We're getting a new inflation number today, actually in about a half an hour, which is going to have an impact on markets. So, let's play out a scenario where this inflation starts to come in a little lower than expected, right? How does the market respond? And what are some of the dynamics that might be causing inflation to come in lower than expected on the growth side or on the liquidity side? Maybe let's just sort of war game what that might look like.
Yeah, so let's say Fed comes out or the numbers come out for inflation and they are way below expectation. Well, that's generally good news. If you're a business owner out there, you know that lower input prices allows you to actually momentarily benefit from that, right? You might be able to continue to maintain your high prices that you've increased over the last year and a half, get a little extra profit, you have some extra cash flow for yourself to reinvest back into the business. So that's pro-growth. That's likely to help equities go up. In fact, the first time we saw a lower inflation print than expected this year, I think the NASDAQ went up 7%, for example, right, in a single day. So that's going to affect equities positively. It might even affect bonds positively as well because of the dynamics that we talked about, right? All of a sudden, cash may become slightly less attractive than something that you can get in bonds. Commodities are likely to go down. So we just talked about commodities being a great hedge over the last 12 months, but really that's going to possibly hurt your portfolio, right? But now you have these three components that we talked about. They're offsetting each other, and they're really acting. Bonds and equities are now positively correlated to the upside. You feel like that's a good thing, but ultimately what you want to do is be more balanced, and that commodity portion allows that volatility to go down. So that's a scenario if indeed the price or the inflation is lower. So what do you think happens if inflation is higher?
Yeah, I mean, if we get a positive inflation surprise, I mean, the other side of that is, why is inflation lower, right? Is inflation lower just because some key prices are moderating? Labor doesn't have the same level of negotiating power, so wages are not rising at the same rate, or maybe wages are coming down slightly. So we're still maintaining levels of consumption. The economy is still chugging along and growing, but we're just having a general price moderation because supply chains are freeing up, that sort of thing, right? That's a different scenario than if we're seeing prices come down because of a slowing economy, or the economy is slowing at a faster rate than expected. So now, not only are you navigating a positive surprise on the inflation side, I mean positive as in positive for the markets, right? Yeah. But you're navigating a higher potential for a negative growth shock, right? So if you've got the potential for growth to be slowing, negative for equities, positive for bonds, against the fact that inflation is coming down, which is positive for equities and positive for bonds, right? So you've got two scenarios that are positive for bonds, one scenario that's positive for equities. So on balance, maybe on a relative basis, it skews more positive for bonds than for stocks, right? Now, as you say, maybe we get a positive surprise in inflation. In other words, inflation comes in hotter than expected. Now, what does that mean? It means the market is now expecting that the Fed is going to have to be more aggressive than it had previously thought in combating inflation, which means the market's going to expect that rates are going to have to go a little higher than expected before. That at the moment, the Fed is currently draining about $90 billion a month of liquidity out of the market, right?
It's tightening.
It's tightening. It's tightening both in terms of raising interest rates and draining liquidity for the market that it had injected in the market to help support markets and the economy during the COVID crash, right? So now it's draining it. It's been draining it since June, and more aggressively since September. They're going to continue draining liquidity for longer than expected, right? At the same time, you've got higher input prices for companies. You've got probably higher returns on cash. Cash becomes more competitive against risky markets. And so you can see how this dynamic gets really complicated really fast, right? And so again, bolstering this view that in an environment like this, you can't just rely on the constant rise over time of a stock and bond portfolio. You need to think more about diversification. And we'll close in quickly now about other ways we can think about diversification.
Yeah, look, I just think that the key takeaway here is that your intuitions are going to fail you if you're counting on your personal investment experience in order to survive. And so you need to look at history, understand these dynamics that we've been talking about so that you can use other tools. Some of the other tools that we've discussed have been commodities, have been cash. But if you have a professional financial investor that can help you understand things that you can benefit in downward markets, like in managed futures funds or global macro funds. These are funds that can invest in all the commodities, all the equities, all the bonds, go long and short, take advantage of volatility and actually profit from high volatility. Now this is another tool in your box that you can use in order to minimize volatility and possibly even thrive in an environment like this, right? But you have to move away from your intuition now. It's time to get down and do some homework, go read some history books, understand markets in an inflationary regime, and do well.
Yeah,
rather than
time to
barely
learn to
surviving.
row instead of just relying on being able to sail in the direction of the wind.
That's right.
So, yep, thank you very much, Rodrigo, for taking on this episode of Money Sense with me. And to
Thanks,
everyone
Adam.
else,
That was great.
have a great
As
week.
always.